It's very sunny where I am right now. I'm wearing my hat to prevent my eyes from having an issue. So let's rock and roll. Anyway, so we're all kind of on hold for the jobs number that's coming out on Friday. We've had about 2 weeks in range. Yesterday, 2 days ago, we had a look above and fail. Yesterday, we had a look below and fail. Yesterday did have poor lows, though, so there wasn't excess. Today's highs, I believe, let's take a quick look. Were they poor? No, it's funny. They were poor RTH, regular trading hours, but the futures trade another 15 minutes past the 4 o'clock close. For those of you who don't know, by the way, you can trade SPY options till 4:15 on any day, and I often do. Anyway, the story here is that the highs, I guess, were repaired here. So you do have some poor lows. The market for the last better part of 2 weeks has been in, I guess, just consolidation mode. It seems like there's two ways you can have a correction. You can have it either by time or by price or by both, meaning it's going down and it's taking some time. We've been basically going sideways and working off a lot of the excess to the upside. The 20 MA is fully caught up. It held yesterday with a bit of a look below, and you have the 50 MA, the 100, 200 are all now curving up. The 200 MA is roughly in SPY. We are here around 204s. 100 MA is in 108s, almost 109s, and 50 MA is into the 111s, which is an interesting number. If you recall, the big resistance areas that we were experiencing were all centered around 210, 211. So now you have past horizontal support and now moving average support that's moving up through there, which is, I guess, better for the bull case. The levels I'm watching here in the immediate term, and you could use either one of these. I usually like to be a little bit stricter with ranges, particularly with downside. The 215.31 to 215.62, let's see, yeah, 62 are kind of the must holds here if you're going to hold the range, the consolidation range that we were in. And we had a double top, poor high. I think that was Monday and Tuesday. No, I'm sorry. What am I talking about? It was on Friday and Monday, and then we had a bit of a liquidation break. It came back down. I mean, there's a lot of people I notice on the stream. They're talking about outside days or outside weeks. I mean, you've had 2 weeks in a consolidation. I don't really look at it that way. I think that's more useful if you're not in as narrow of a band. So I'm just watching the range. If we can get back up above those 217.65 high, I think there'll be a squeeze higher. And if we were to take out the 2-day low now, I think we will see a bit more of a correction. The breakout level was 213.78, and the failed head and shoulders kind of high there, and the last reference high was 212.52. That area should hold with maybe, if it gets a little steep, the maximum I'd be willing to see here is the 209.53, which is really the gap fill from the trend line break. But I would think that would be, it really shouldn't be back there so quickly. I'm really watching the 210, 211, that range, and then, of course, the 213.78 to 212.52. Believe it or not, a pullback to there would be still very healthy. Usually what happens is you have the breakout, the check back, and then the resumption of trend. It actually starts getting more and more dangerous if you don't have at least some corrective action. Well, we've had 2 weeks of sideways action, so all I'm doing here is watching the range. If we get a definitive break to the downside now, I'll be trying a right or right out short. If we break to the upside, I'll be doing a right or right out long, which is the way I see it. I watch the VIX. I like to watch the VIX. It's hovering around the lows. I don't think it's so useful here. I will say this, that the last swing low of the last couple days is a slightly higher low, which could imply a little bit of a pop. Just my feel of the tape So what happened yesterday? I think you just had a lot of people who were piling in long, assuming that the breakout was going to be to the upside, and they just got their hand slapped a little bit. Like, I don't want to mention anyone by name. I don't like calling people out, but some of my favorite chasers were in there with some of the with some stocks, and oddly, I agreed with them on a couple of them, which made me even more nervous. One of those was Apple. I discussed in the weekend review video that the behavior in Apple seemed bullish. I thought that the price action on Monday seemed correct. I was a little surprised with how vicious the sell-off was yesterday. I mean, in the context of range here, I mean, it wasn't like the stock completely collapsed. But it just, to me, looked like programmatic selling. If you looked at how every bounce to like the VWAP and it would sell off and sell off, it just seems a little forced to me. I still think Apple, as long as you can hold the 200 MA, is likely to see that 109, 110 to the gap fill. I'm currently long. I have some shares, and I also have some risk reversal call spreads. I think they're in October. Let me just take a quick look. They're not in this account. They're in another one. Let's take a look there. That one had the shares. Okay, so this, yeah, so a 105, 115 call spread, and lightly short the 95 puts just because there's not a lot of IV in there. I don't like to pay up, and I think at this point 95 should probably hold with Apple, considering it's firmly through the hundreds. 100 should really be 100.72 to be exact. That area, 99 to 100.72, really should be the support. So that covers Apple. I covered SPY. Alrighty. So what's been moving things around? I think the market has been able to ignore, for the most part, the move down in oil. That is a little dangerous to me, and I had talked about it still being controlled, and I was expecting a little bit more of a steep move. I discussed the 200 MA possibly being a secure low. It was not. You need to have the next day the next day's bar low higher, and then take out that bar's high. That never happened. That trade never triggered. So we now had a break below, a check back that failed, and now a close back above the failed check back, which to me I thought got a little bit of a squeeze. I noted yesterday on my stream that I said to watch Exxon. It struck me as strange that you had oil down and everyone on TV and everyone all over the place talking about how terrible the move in oil was, and yet Exxon was not down. That to me is always an important leading indicator. And it doesn't surprise me today that even on bearish inventories, we got a bit of a relief rally. The low was a slight undercut, yeah. And then it rallied back up and closed. So now you need to look at the 200 MA again. If we were to fail tomorrow again, I still would say that the fibs are in play. I'm looking at the 50% fib, which is 38.86. And this is on CL, of course. And then the 61.8 is at 35.84. I use the absolute contract, the /CL for these levels, by the way. I do believe this correlates with the U6, but in the chart, I have it as just /CL. So if, yeah, it looks the same to me, actually. I'm just pull up the U6. Okay, so that's what I'm thinking. If it is a fail, and we're going to come back up higher, like a failed breakdown, I think that this is going to run into some trouble. First and foremost, the level I was watching was 42.49, but I think 44s to 45s will probably be some stiff resistance, because that would be a move back to the mid-channel. Anyway, as far as Exxon goes, the aforementioned Exxon, I don't even need to look at the chart because I know this thing so well. 85s and 86s are a big level that held. If that were to break, we could see 83s to 81s, and at that level, I'd be looking to sell some puts, preferably 80 or below. I think 78 is roughly the trend, so into that area to me would be an amazing put sale, considering we've come down so far from the top. There's a lot of talk about Exxon cutting their dividend. I would be shocked if that were to be the case. I think they'll do tons of rounds of layoffs before that would even be possible, and it seems to me like that's BS. Some of the other ones, I don't know. We'll have to see how that plays out, but I think that a lot of these large integrateds are probably a little bit more better capitalized than people realize. The one thing that disturbed me in the Exxon report, and I think this is what kind of got the analysts' panties in a bunch, is that they're borrowing money a little bit to fund their dividend, which isn't fantastic. The caveat there is that Exxon can borrow so cheap, it's almost like they're not paying very much interest. So this could be a backdoored way of them changing their capital structure, which would lower their WACC, the weighted average cost of capital. So thus making it a supportive stock price. Of course, no one else on television discusses this, but this is why you tune in to me. So that is what I'm watching at. So it's a little bit, I'm not fully hating what they're doing, but I'm not 100% loving what they're doing. I think that they're going to kind of just play the wait and see type of game. That's Exxon. And think about that capital structure play. When Exxon, if it does get back up over 100, this will be very widely understood. All right, let me go back through the list here. Metropolitan Life Insurance. Someone was texting me about that today, and saying that it looked to them like it could be a potential for a professional gap. I said the setup looked good, but this is again why we don't jump the gun. It's very tempting to take a look at a stock like this and know it's going to be higher. You see it, it's right on the trend. I mean, it's consolidated a lot. Why not buy it today before the gap? The answer is that you don't know that there's going to be a gap, and I would have and I also saw that there's 200-day moving average resistance slightly above it. So even if you did get a gap, it would be already having come up from the range. Remember I talked about coming up from the bottom? You'd have been coming up from the bottom and then breaking out, although this did do many days of consolidation. So the play actually looked good to me, but again, not to jump the gun. That's my theory. I want to show that. I'm going to discuss that one in the weekend. I think I have to table that one a little bit more for the weekend review video, just because the technicals of that are. This is a really good case of why to be patient. I don't want to spend a ton of time on Facebook, but I do have to discuss it a little bit. We're basically right on the 10-day moving average. Facebook is doing exactly what it normally does. It ran up into earnings, it gapped, and it's coming back down. It's probably going to chop for a while. I like selling strangles in there because I don't see it doing very much. The bull case and the bear case. The bull case is they crushed the earnings. Absolutely fantastic. I don't want to hear. I know there's some. I think it was Scotland or Ireland, some type of tax concern or whatever, but the stock the earnings were fantastic. They are just killing it in mobile and social. If you take a look at Instagram, they added on, basically like a Snapchat-like ability to do stories with video that deletes after 24 hours. I've been seeing a lot of people on my Instagram using it. It seems to be popular. It doesn't have the filters yet, but I mean, Snapchat, let me do a little detour here. I promised I would discuss my take on the Snapchat, Instagram, which, Battle of the Titans there. It was on TV the other day, and I tweeted out that I was going to discuss it in the video today. So here's the breakdown. A lot of people like to screw around on Snapchat. It's very, it's fun, it's got the filters, it's still very half-baked, and it's not going to have much of an appeal past, very young children. Instagram, on the other hand, is being widely adopted by business, and I've discussed, because most Wall Street analysts don't know tons of models, I happen to know several, and their agencies, their bookers, tell them that they have to have over 10,000 plus Instagram subscribers to get work. So it's a matter of futzing around with your tongue sticking out on Snapchat versus building your career on Instagram. It's a very little known distinction, but I know this because I know the people who are doing this. That social media platform is blowing up. Instagram is crushing it. I know the people, by the way, I know who use both. And I know far fewer people. I mean, I'm a little bit older. I'm not, hanging out with kids on the pier over here. But the people using Snapchat are still relatively a hell of a lot smaller than Instagram. It doesn't have the ad bundling package when you go to book. Let's say you're a Facebook executive and you're going to make an ad sale to like a big client. You can bundle in that you're doing both Instagram and Facebook and do some type of cross promotion. This is not possible on Snapchat. Well, I think Snapchat, I've said for a while now, I would love to see, believe it or not, Apple buy them and bake it into the right into the camera app as an add-on and clean it up a little bit, and maybe even let the Snapchat guys redo the Apple app. I think that would be a viable competitor because it would have a built-in advantage. And then that would be, in my view, that could be real trouble for Instagram. I don't see it as now as being as big of a threat as people think, and I think that most people use both, frankly. I even see people post their Snapchat videos on Instagram, believe it or not. So that's the view. That's really the truth behind the quick and dirty between Snapchat and Instagram. I like Snapchat. I think it's going to have a ton of potential going forward. They're growing very quickly. They have a great product. It's a little gimmicky, and it's not as business-focused yet as the Instagram situation. All right, so that's... with regard to Facebook, the breakout level was 120.79. The 50 MA is rising in the 117s, and the range low was in the 116s. This is going to depend, of course, on the market. If the market gets real iffy, we could see that range low. If it holds in there, it'll probably hold, somewhere between the 120 and the trend. We still haven't even, believe it or not, broken trend. I see a ton of people. I think that the problem for me for Facebook, why it didn't hold those gains, is because you had a ton of people chasing the stock in weekly calls, again as always, and they needed to book profits. And I think it's just kind of working off a little bit of that time. It could spend some time correcting. I think the better play in this is to sell out of the money strangles, meaning sell out of the money puts and sell out of the money calls. It'll probably wind up chopping around. Someone asked me if I was short Facebook. I'm not. I don't think it's really a short. I do think at some point there'll be, that kind of like flush break to trend and then rally, but it could spend days or weeks in consolidation. If you've looked before it really can be fruitful, I don't think that will be so much of a profitable trade. I do think, though, that selling out of the money premium on a decline to sell the puts and then the rally to sell the calls, or if you're, don't want to time it, just sell out of the money on both. Very near dated because the IV in there isn't anything to write home about, and if there's any type of pop in the IV, it'll be a problem. Chipotle, someone asked me about Chipotle. I'm really a little surprised at how this sucker has been trading. They had a terrible earnings report with their comps were down 20%. I mean, it's funny. I was a huge Chipotle fan. I haven't been back, since the whole thing started. The 100 MA has been grim death on every one of these rallies. This time was no exception. 442.40 was a important old high that was kind of roughly a support that basically rejected. Now it's coming back down. You're basically mid-range here. Someone asked me about this last night. You're basically back testing the breakout of the trend line here. This is really like the must-hold area. 397.74 to 400-ish. If you lose that, I think you'll test the range low, and they'll probably want to run the lows to see what's going on down there. Think like a machine. I always talk about the algorithms. They're going to want to see if they can run stops and what's doing down there. So it really needs to hold kind of right here. If we were to get a move back up above today's high tomorrow, you'd probably get a bit of a squeeze back up a bit. But this stock to me just looks like I would stay away. It looks to me like more of a short on the 100 MA. This is a stock making lower lows and lower highs. Short the 100 MA for right or right out trades. If you want to play long, it's basically right here. I was going to use screw it, right? Balls to the wall. It's do it here. Do or die here. 399.14 to 397.74. It needs to hold there, or it is probably going to be toast. Fitbit, one of the silliness stocks. Actually, I was talking about this on the stream last night. They beat the quarter. They didn't muff the conference call. Amazingly, that CEO is like one of the most self-deprecating people on a conference call. They just blow it every time. We have to now make sure, though, it wasn't a one-day wonder. The technical pattern was starting to bend back over and looking a smidge bearish. I would consider today, if it can extend and hold, a mini professional gap. So we can probably see this thing get back up to the gap fill is my guess. If you think like if you put your trader's cap on, that would be roughly 1710-ish. So anywhere in the 17s, I'd probably be looking to set between 17 and 18, looking to kind of book them, Dano. Wynn, not one I follow very often. I'm a big fan of Steve Wynn, particularly his politics. Starting to look a little head and shoulders-ish here, but it's really just in a range. Let me move up this fib. I don't have an accurate fib on here. All right, so yeah, it's slightly below. It's been kind of trading on the either side of the trend line. I'm going to draw on a different trend line, one from this leg. I would say if that trend line stays, this area here, yeah, this is to me a little. This is a little iffy. It's still a little bit below that. If this were to crack like 87.16 again, to that roughly the neckline there, then I would see the problem is you're still so far away. Here's my theory on this. If you're long and you're debating on a stop, just use the 100 MA. That's what's been supporting. If you lose the 100 MA, you could try right or right out short. And if you're long and you're looking for an add, if you can get back, if they head in this fake, double top head and shoulders, if it becomes fake and it fails, you can add to the position over the 105s once those clear. But 100 MA is the must hold here. That's my call on the chart. I just did that one cold, so the analysis, like for that, for example, is probably not as well crafted as Apple, but believe it or not, I think it'll be accurate. Someone asked me about JetBlue. Strange, they reported a pretty good quarter. Again, the 100 MA that seems to be grim death. It was also stopped up at the range high. Highs in there are pretty poor. It's back testing it's testing the backside of the downtrend line where it had broken out from a little bit lower. I just have to plug in the phone here. It's dying. There we go. Yeah, I mean, it's got trend and channel here. If this loses the earnings gap low, though, the 1680, what was the close today? 1690. The low was 1677. Yeah, so if you start losing those lows, I mean, I don't necessarily know if I would say it's a short, but it's probably not one you want to be as long. I have a small long in this, in full disclosure. I haven't really been following it that much because it's a very small position. These airline stocks have been creamed. I'll tell you, if oil and gas keep coming down, they are the huge beneficiary from that. I know there's a lot of concern about the Zika virus or whatever. So I think that's really been what's weighing on this. I'm not necessarily sure it's going to play out that way. I know that some of the other airline execs said it wasn't it wasn't necessarily they weren't seeing declines in there. Let's just use the earnings range. If it loses those lows, just GTFO. And I guess if you really want right or right out short, I just think that this is going to be choppy. That's sort of my take on that chart. Tesla. Let's end on Tesla. How's that? Although I do want to talk about a little bit of macro stuff. All right, so Tesla put up a pretty big loss in their quarter. It was double the expected amount. The stock initially went down, then it rallied, and now it's kind of flat. I think it's waiting on the conference call from Elon Musk. My theory on Tesla is this: how I played it. All right, so those of you who've been following me, I've been involved in a long Tesla play since the trend line breakout. I've had 2 rounds now of short puts that I closed profitably, and I closed a short higher call. I had been short puts that funded a call spread or a risk reversal, a short put risk reversal. I'm sorry, a call spread risk reversal. I don't know what I'm talking about here. Call spread risk reversal, that's the correct term. Meaning you're short a put and you're long a call spread. I had been long to 230, 260. I lowered that to 245. So I booked 2 rounds of short puts and I booked a short call. My cost on the trade I think now was maybe like $3. I left on some of the call spreads just for shits and giggles. Wow, I'm a little bit of a potty mouth today, sorry. They didn't burn through as much cash as they had expected. If the stock can't go down on that number, it's probably going to squeeze higher. There's like 28% short interest. I've always thought that Tesla isn't necessarily a function of anything fundamental in the company. It's a function of the mechanics of the stock market. Poorly distributed stocks, meaning institutions don't own it. High consolidated insider ownership. Musk and his cousins and family own a lot of it. And it's heavily shorted. That means that there's not a lot of available float out there to really do too much if you're not on the right side with them. And the stock goes through periods of, puking and rallying and whatever, and it's basically right now at a key level, these like 24s to 26s. It's been acting a little funny. It broke out, and then it kind of had its stutter step on the master plan, and now it has the Solar City noise around it. It was very, very noisy. That's why I didn't do the position very large. It's very small. If this wasn't as noisy, I probably would have played this in more size. I don't like when situations are noisy. It makes it harder to focus on the technicals because there's a lot of move. It's like herding cats. You're dealing with the Solar City issue. You're dealing with the master plan, which was a bit of a sell the news. Although, it's interesting. I've read tech blogs that talk about Musk, and then I've read, in the master plan, and then I read like the Wall Street reports, and I can't even tell you the polar opposites. When they talked about the Solar City deal, I think TechCrunch said Elon Musk is going to own the sun. So, and they showed a wing guy flying or whatever. So he's loved in the tech industry. I think a lot of people don't know, but I believe he invented PayPal. So the guy has a pretty interesting history in the tech sector. How this is going to play out for their earnings, now it's going to be up to the conference call and I guess expectations on deliveries and if, how Musk communicates the stock. It seems to me like he's trying to manipulate it a bit higher with varying degrees of success here. So, I know he's got that deal coming up. It just seems to me that he would do what he could to kind of boost the stock. I think it would behoove him for it to be rallying into the Solar City merger than it would be if the thing gets absolutely pancaked. So we'll have to see how that plays out. I discussed how I played it. If the thing winds up being a zero for me, it'll wind up costing me now after expenses at like $3 in the trade. So if it's a zero, I honestly... $3 is $3. I don't like to say I don't like, it's important to me, but it's not going to, it's not going to make me rich or bankrupt me here. So that's my view on Tesla. If it can get back above the after hours high, the initial spike I had posted was 231. I was on the 15-minute bar. Now it really kind of it was a little bit before it closed. I thought the bar had closed. It didn't. 233. It needs to get back through there, and I guess this 20-period MA on the 15-minute, which is around 230. If it can clear that area, I think it'll have some legs higher. If it starts, listing lower, I don't know how much bang for the buck the shorts are going to get here, but they probably will try and take it. My guess is back to the 50 and 200 MAs, which are roughly where it bottomed in after hours. Oddly enough, the spike low was, the 200 MA is 216.71, and the spike low was 216.5. So that'll probably be where shorts would try to take it if it. So it'll probably be, my guess is $10 higher or $10 lower. I think the expected move was only about 14 or $15, which seemed a little muted to me, but maybe that actually wound up being the right thing here. Quick macro talk here. I usually lead off with that, but we'll fix it up. We'll fix that up here. PMI service index, I believe, was in line. And then the ISM was a slight miss. That's been multiple misses now. I guess those much coveted seasonal carnival ride operator jobs are drawing to a near end, and the jobs market is probably maybe slowing a smidge. The ADP number was a bit of a beat. It was actually better than the last time. The consensus was 165. The actual was 179, so a decent beat there. The prior was 172, so it's incrementally higher. That's good. They had a pretty wide range, though, 160 to 185, so they were kind of, that's not exactly precision in my view. But we'll have to see how the NFP is on Friday. I think you'll see if it's really weak, you'll have people talking about recession. And if it's strong, you'll have people talking about rate hikes. I don't necessarily know that is going to be what moves the Fed. We just had some GDP estimates that were lowered and revised lower, and really piggish numbers. I mean, the growth is like they can't even they're struggling to hold like onto 2%. There's really not oil is moving in the right direction for the Fed. It's pulling back. I mean, I just don't see why they would be looking to hike here. I do think that December is likely on the table, just kind of for like because they can get away with it in December, and they've talked about it. I think it would just be kind of they got to earn their spurs. But Lockhart is always looking to talk tough. But it just seems to me that they don't have data that supports a rate hike, and I'm still in the lower for longer camp. I think really, irregardless of what happens with the employment number this week, I know listen, the market's going to trade off of it, but I don't believe, even if the number is a little hot, that the Fed is going to jump, and make the September move based off of one unemployment number with crappy GDP. The quality of the jobs, like I said, there's been a lot of part-timing. Waiters, waitresses, bartenders, carnival ride operators. There's only so many Ferris wheels to operate, and there's only so many people you can stick behind a bar. The wage growth, that's really what you want to look at. If there is wage growth, and I'm not just talking about small incremental wage growth, I don't see any real significant wage growth over, really, frankly, the last decade. I mean, it's been wages have been stagnant. I mean, if you look at what people were making years ago, relatively speaking, I mean, they're making less now. Expenses, you have kind of what I've heard is referred to as screwflation, meaning some of the metrics have been higher that don't normally get factored into what the Fed looks at, like healthcare insurance has been up the past few years, although not recently. Energy and then food, but wages aren't rising. So it seems to me that it would be very hard for the Fed to hike into that. Anyway, I don't have that much more to say today, since the markets have been just kind of choppy and sideways. You now have my levels, and I'll revisit on Sunday in the weekend review video, and I'll have had of course, we'll have seen the employment numbers and the market reaction to discuss. Anyhow, that's my story. I'm sticking to it. If you came into this late and you want to catch it again, or want to see whatever, it's going to be on my YouTube channel shortly. That's Justin Pulitzer Trades. And if you're not following me on Twitter, my handle is @JustinPulitzer. I hope you guys enjoyed the broadcast, and cheers.